Well, welcome to the Central Kentucky Computer Society Tech Night. Tonight, um, we are pleased to have Phil O'Neill here. I'll have you come up, Phil, to introduce you. He is a seasoned tax aid counselor with AARP. He came last year in January and told us about the tax season coming up. And then he decided he was going to join CKCS. And then he decided he would teach a class on cybersecurity. So there was was it a 6-week class? Four-week class on that. And then he also jumped in and is helping with iHelp and Dr. Fix-It that we have the first Saturday of every month. And then he's also a presenter for all things Apple special interest group. So he's really gotten involved and said that he would do another tax presentation for us because there are a lot of changes that have come about in 2024. A little history. He's a retired electrical engineer who was educated, you'll soon hear, from the University of Bath.
City of Bath, not Bath County.
Yes. Did I say Bath County?
No.
Oh,
No.
I could see me saying Bath County. Then he moved to California in 87. And then that was to support
It was a Marine Corps program.
And then you got recruited here to Lexington, Kentucky.
That's right, yes.
And so he and his family moved here in 2002. So they've been here ever since. But so it is our pleasure to have him again this year talking about taxes. And I'll turn it over to you.
Okay, thank you, Brooke. So, hi, everyone. It's nice to be here again. As Brookie said, somewhat seasoned, some say just salty, but that's a matter of opinion. So today we're going to talk about the changes to the tax laws that came about from the 2025. And there's a couple of unusual things about the 2025 tax changes, but we'll come back to that. Now, today I'm wearing a hat as a counselor for the AARP Foundation's tax aid program. And this was founded back in 1968, and it's the largest volunteer free tax service in the US. You might hear the word free this time of year when people are advertising their tax programs, but we are absolutely free, no charge. We're not allowed to accept tips. If you try to give us money, we'd have to tell you no. We have on occasion accepted cookies, though. So there's hope for that. So, exactly. It is a free service. It's staffed by volunteers, and it's open to everybody, any member of the public, not just AARP members, which is a little bit of a misconception that we've been trying to dispel, but it's still out there. And what we'll do for you is we'll file both your state and your federal returns electronically, give you a copy that you will take home for your records, and then hopefully you'll come back in another year and do it again. We file taxes at several locations all around Lexington. There's 5 libraries. There's a library in Richmond. We have a church in Winchester, and the senior center that's just off of New Circle is another location. Our only limits are our capacity and getting enough people in. And so we're always recruiting. So if anybody's interested in learning to file taxes, let me know after the show and we'll set you up for next year. So one of the questions we have is, do I have to file my taxes? So I really gotta, really? And that's because there's nothing sure but death and taxes. That's what they've been saying for a while, and no one's proved them wrong yet. So who needs to file their taxes? And that's most people, but not everybody. So if you earn over a certain amount to the point where it's around about the threshold is round about the standard deduction. So if you earn less than that, you probably don't have to, but we do recommend that you do so because there's a lot of identity theft out these days. And once someone files a tax return using your social security number, no one can do it again. So even if you don't have to file your taxes, we recommend you do so so nobody else can and run up big bills in your name.
What's the standard deduction this year?
This year, the standard deduction is about $17,500 for a single person, just over 30,000 for a married couple filing jointly. Okay. So you also want to file a tax refund for a tax refund. If you paid taxes and you're owed money, they're not going to just send it to you. You have to file your taxes to tell them how much to send to you. So that's another reason to file your taxes. And I mentioned, got a little bit ahead of myself, some choose to file even if they don't have to because of identity theft. So that's a growing problem these days. And one of the safest ways to stop people, even if they've stolen your social security number, would be unfortunate, if they then can't go on and file taxes in your name with made up numbers claiming big refunds, it's the only way of stopping that from happening. So if you have to file your taxes, well, there are several ways. There's ads all over the TV this time of year. But the one I'm going to talk about is AARP's tax aid program. All of our counselors are volunteers, and we're not CPAs. We're not trained as accountants, but we are trained by the IRS to operate within the scope of what we do. So we know enough to take care of our clients who are generally individuals. It can be single, married, young, old, working, retired, college students. We take care of all of those, and we're trained to handle all of those situations. And every year we have to recertify because the laws change. So all the tax laws change, so we have to change too. Okay. So I mentioned already that the service, it's open to everybody. RP membership is not required, but we do only do personal tax returns. We don't do businesses. And when I say personal, but not business, self-employment. So if you're a contractor, a freelancer, a DoorDash delivery driver, an Uber driver, Lyft, that kind of thing, that's included because that's self-employment. When I say we can't do a business, it's a business that has, for instance, premises and they carry inventory that depreciates and employees. That's outside of what we can do. So just individuals and personal taxes is what we take care of. We do have to be very careful about security. And so anyone that's going to come and get their taxes done by us, they have to come in person and they have to identify themselves. We have to verify their identities. We have to match their social security cards with their picture IDs and the addresses that they're giving us so that we are sure that we're talking to the right person about the right social security account and filing in the right name. So we're very careful about that. So said you have to show your photo ID, also your social security number. And that's because, once again, identity theft is a very big problem and it's growing all the time. As an aside, and as a shameless plug for Ben's Cafe tomorrow, this is exactly what he's going to be talking about. So outside of the technical aspects of identity theft and how to prevent it, he'll also be talking about the social aspects of how you can get drawn in by scammers and separated from your money so painlessly you actually want to give it to them. They're very good and they're very evil. So yeah, tomorrow in Ben's Cafe, we'll be talking all about that. So moving on to taxes and technology, you've got a couple of did you know facts for you. First one is, did you know that the IRS has individual accounts, and you can go to the IRS website, irs.gov, and you can sign up for an account, and there you'll find all of your tax records. You'll find your tax transcripts going back several years that you can download for your own records if you wish. It uses an authentication service to get you into the website. It's very strong. It's a service called id.me. Previously, it used to be done through the mail service. So in the same way that if you try to go to a website and they say, we'll text you a code, used to be when you went to the IRS website, they said, we'll mail you a code. And a week later, you got a letter with that code in it. They've improved a little bit since then. It's all automated and a lot faster. But I kid you not, that is how they used to authenticate. They would mail you a code. So, did you know the IRS has a phone app? It's called IRS To Go. It's got some limited functionality compared to some apps out there, but it can deal with some very important features like, first of all, where's my refund? If you're expecting a refund, one of the most important things is, when am I going to get it? This can help you figure out where your refund is in the process after you file your taxes. It also gives you some payment options, helps you contact the IRS, and can also help you locate some of the tax services that are out there, one of which is AARP's service. It's got a web-based locator where you put in your zip code and it'll tell you the locations in your area where you can get your taxes filed. And then lastly, did you know, talking about security, the IRS uses two-factor authentication, and it's called an IP pin, identity protection pin. And every year this is refreshed, and then you have to know that number to file your taxes. If you're going to file electronically, you have to have that pin in your tax return, otherwise they won't accept it. So that's a level of security that's been brought about because of, again, identity theft. People have had their identity stolen. They've been notified by the IRS that they've had an issue, and then the IRS issues these numbers so that you can make sure it's you filing your tax returns. They know it's you because just like those codes that get texted to you, there's a code in your tax return that has to match before they can accept it. Okay. Last point about that is, even if you haven't had your identity stolen, if you think it's a good idea, you can go to the IRS website and request a code so that you can't file your taxes without it. So that's a level of security that you can proactively request and then use that going forward. So that's a little bit about tax aid. But now we'll get to the good stuff. What's going on for 2025? Well, a lot is the short answer. And one of the very unusual things about the tax law changes for 2025 was they were retroactive to the beginning of 2025. Usually, tax law changes take effect in the following year or the year after it. Because these were introduced in the middle of the year, retroactive to the beginning of the year, a lot of people, both employers, payroll services, the IRS, we've all had to scramble to come up to speed to allow people to file their taxes accurately in the season we're coming into, which is for the 2025 tax year. So there's been a lot of questions, a lot of head shaking, and well, what do you mean by that? Kind of looking at things sideways, trying to figure it all out. But what we've got here is the best information we have to date, and we feel it's pretty accurate, but there still may be some things that are not 100%. So here we are. The first one was there was the Federal Social Security Fairness Act. And this is for individuals who were receiving pensions but were not receiving Social Security, even though they had paid into the Social Security system. This was reversed and applies to the two best examples are teachers, firefighters. If you've had a job before you went into government service and paid into Social Security, you previously did not get Social Security, but that's changed now. And this is even more retroactive than everything else because this goes back into 2024. So people were getting benefits, Social Security benefits that they weren't expecting, and they were paid as a lump sum. So people would suddenly get a big amount of money in their bank account as a Social Security payment, and they scratched their heads and went, well, okay, good, but why? Because it was a change to the law that people who previously were not eligible for Social Security, they are now. And that lump sum, even though it's part of Social Security, becomes, unfortunately, part of your taxable income. So we have to take that into account when you come to file your taxes. So what we're anticipating this year is going to be several. Usually we see retired teachers, they'll suddenly be bringing in Social Security statements with like, woohoo, I got all this money. Okay, right, now pay taxes on it. Sorry. So you win some, you lose some. That's a net gain because they're getting Social Security after all those years with, as I said, back pay through 2024, and they'll be getting it going forwards as well. But that was a surprise. A lot of people received it and had no idea it was coming. So, yes, Mike.
Yeah, you get the social security form.
Yes.
I can't remember the number on it. Down at the bottom, they had a little asterisk and they said something was included in that total. Is that the extra amount we got then?
I
don't know.
You have to be a bit more specific than that. I can talk to you about it later if you like. It generally said something about 2024 past benefits or something like that.
Yes.
But it was usually a substantial sum. Some people were getting thousands of dollars they weren't expecting. Okay. The next one was the 2017 Tax Cuts and Jobs Act. A lot of the changes were made permanent. When the law was first written, a lot of the changes were only effective up until 2020, end of 2025, which is where we are now. So those previously expiring changes, they've now been made permanent. So the tax rates and tax brackets that were written into the law in 2017, they're now permanent and will be subject to annual indexing. So they're not static, they're going to be updated every year. And just to give you a little bit of tax terminology, when I say permanent, I mean as permanent as it can be until Congress changes the tax laws. So there's always a little bit of, well, yeah, well, say permanent, but then they changed it and that's Congress. The next is the increased standard deductions. They were also set to revert to 2017 levels and they were a lot lower. A lot of people get a much better deal with the increased standard deductions now than what they used to when they were itemizing deductions. So we don't see many people itemizing at all these days. It's generally much more advantageous to take the standard deductions. Okay. Other credits that were made permanent, we've got the child tax credit, the additional child tax credits, and the other dependents credits. So the child tax credit was 2,200 a year, up to which 1,700 was a refundable credit. What I mean by that was some tax credits will just reduce the amount of tax that you owe, but if it takes your tax down to zero, then it stops. A refundable credit will say, for example, if you owe 2,000 to the government and you get this tax credit, you would get a $200 refund because it's a refundable credit rather than a non-refundable. So that's what that terminology means. There are limits on these for your adjusted income, and these start to phase out when your income is 200,000 or above, or 400,000 for a couple. Wish I had that problem. Other dependents credits was made permanent. That's $500. And then moving on to some programs that were terminated. Several were brought to an end in 2025. Credits for electric vehicles, new vehicles, that credit ended at the end of September. Used electric vehicles, that credit ended. And then the energy efficient home improvements ended at the end of last year. So if you bought a furnace or new energy efficient doors, highly reflective windows, those, if you bought them last year, you'd be eligible for a tax credit. If you bought them in 2026, those credits are no longer available. So, okay. So one last thing about that is if you're going to claim those credits, we need more information about the manufacturer of the doors, the windows, whatever they might have been. And that is something that you can get from the installer who put the doors or windows in, and is probably already included in whatever documentation you got from them when they did the job. Yes, ma'am.
Also gave you a credit for a new heat pump or upgrading your heat pump. Is that separate from this?
I believe so. I think that may be a rebate rather than a tax credit. But what I'm talking about are the federal tax credits that would apply all across the US. KU would just be here in Kentucky. I really don't have a good answer, but short of saying you should just call them and ask, see if it's still available.
Okay, thanks.
Yeah, I don't think that was a very good answer. I'm sorry, but it's the best I've got. Mhm. Okay.
Was fine.
Okay. So next up, and this is what most people are interested in for 2025, is tax deductions. And there's several that are brand new for this year. So, and these are what we call below the line, because these are in addition to your adjusted income after you apply either the standard deduction or the itemized deductions. So you get the benefit of these deductions whether you itemize or not. So these are good for everybody. So the first one was, and you probably heard a lot about these in the election campaigns in the last couple of years. We've got no tax on tips, no tax on overtime. We've got no tax on vehicle loans and no tax on Social Security. Now, that's what you probably heard. What made it into the law is not quite that straightforward. I'm trying to be diplomatic here. Okay. And I mentioned these increase both the standard and itemized deductions. So these are going to be very helpful to the people that are eligible for them. So the first one is no tax on tips. And this is going to be given to It's up to $25,000 is the amount of the deduction. That's the maximum. And that is going to be per tax return, not per individual. So this is a little bit different. So if you're a single person making tips, you've got up to 25,000 to deduct. If you're a couple and you're both working and earning tips, you have the same limit on the deduction. So if you're getting $25,000 in tips, not a bad problem to have. So yes. Now this is where we start getting into the weeds. And when we say tips, they must be voluntary tips. So if you go out to dinner and you get the check, you figure your 10, your 15, 18, 20 or more percent, and then you write it on the credit card stub, that is a voluntary tip. If a group of you go out and eat, like 6, 8, however many, and they add a charge, 15, 18, 20%, that is not a voluntary tip, and that is not eligible for the tax deduction. So that's going to take quite a bit away from people who are working the large groups, but that's the way the law was written. The rule is it has to be voluntary, where you can change the amounts. If you choose to give 15, 20%, however much, that's a tip. If they put the charge on there for you and then say, well, yeah, you can increase it if you want to, still doesn't apply. So. Sorry, was there a question there? Okay. And then as with most of these things, there is a phase out where if your income is $150,000 or $300,000 for a married couple, it starts to phase out. And if you are married filing separately, you're not eligible for this tax deduction. That comes up in a lot of tax laws. Married filing separately doesn't have the advantage of a lot of tax deductions, and this is one of them. Now, the IRS has also said that there are only certain trades that are eligible for this. When this was first proposed, it was said, well, what if the CEO is getting a bonus? And they say, well, no, it's not a bonus, it's a tip. Is that going to be tax deductible? So no, you can't do that. People say, well, if your lawyer's doing a good job and you want to tip him during your divorce, is that going to be a tip? So there are codes for certain occupations that we can look up to see if you are going to be eligible for this. And it's generally food and beverage, entertainment, hospitality. So your waiters, your DoorDash drivers, busboys, they're the ones that this is really intended for. Okay. And so all of this, the tips must be included in the totals that you get on your pay stubs, your 1099s, your W-2s, and it applies also for, sorry, not also, mostly to contractors and, like I said, wait staff. If you're self-employed, the DoorDash drivers and Uber drivers are the best examples. They are the ones most likely to be getting paid a little bit, but they get most of their money from tips. So this is of most value to that kind of worker. So next up, we got the no tax on overtime, which is, you think that'd be pretty good if you're working late, not having to pay tax on the money you earn is just going to be quite handy. So there's a limit on this. So if you have overtime up to 12,500, that's the limit. But if you're married filing jointly, it's 25,000. So it's 12,500 each on that tax return. And then if your overtime rate is time and a half, the tax deduction is available on the half, not the time. So if you get 1.5 times your standard rate, the deductible amount is only half the standard rate. If you're working a holiday and you're getting double time, the deductible part is half your standard rate. So that's how we're going to be calculating the deductible parts of your overtime. And we've been seeing that quite a few employers, but not all, have this calculated and on the W-2s. But we are still asking people when they come to do the taxes, bring your last pay stub from last year, because that's going to have your year-to-date totals that breaks out things that will help us a lot more if the W-2s don't have all of that done properly. So, okay. So the last thing is all the overtime pay must be included on your W-2 or a 1099 if you're self-employed. And I mentioned we are asking people to bring their pay stubs with them to make sure that we can calculate these correctly, make sure they get the most advantageous treatments for their overtime. So moving on from overtime, we've got the no tax on car loan interest. So this is allowable on interest up to $10,000, and that is per year. But the interest is only on the purchase price of the loan. It's unclear if the loan companies are going to be including add-ons, like if you finance a maintenance contract. We don't believe that's allowable, but it depends on how it's reported on the interest forms that we get. And also, if you trade in a car that you owe money on, so you increase your loan amount by the amount just to clear the old loan, we don't believe that that will be allowable. But again, it depends on how it's reported on the interest forms. But technically, it's only on the interest of the purchase price. And it's for brand new vehicles only. So you say you buy a new car, and what you actually mean is, I got a used car, but it's new for me. That doesn't apply. And it has to be a final assembly in the USA. And when we say final assembly, we don't mean Don Jacobs putting a sticker on the back of the trunk. That's not final assembly. We have to do some research, and we can look up from the vehicle identification number which plant it was assembled in, and if it was in the US or not. So we need that information in addition to the interest for information to take advantage of this particular tax deduction. So then lastly, it's the adjusted gross income starts to phase out at 100,000 for an individual if you're single, 200,000 for married filing jointly. So the one that got the most interest, though, is no tax on Social Security. So this is also known as the enhanced senior deduction. And this one is really quite straightforward. If you're over 65, you get an additional tax deduction of $6,000 each. If you're filing as a single person, you get $6,000 if deducted. If you're filing as a couple, you get $12,000. It actually has nothing to do with Social Security. So let's talk that part through. If you're 62, you're eligible for Social Security. If you claim Social Security when you're 62, you are not eligible for this tax deduction. If you are 66 and you are not claiming Social Security, you get this tax deduction whether you want it or not. It's all calculated from your birthday. So who are the winners and losers in that one? It's hard to say, but that's the way the law is written. So $6,000 if you're over 65. A caveat that
They're saying They're saying that there's no tax on social security, but $6,000 is the limit. Most
But-
people can do, you've got to pay tax on any social security above 6,000.
No, it's got nothing to do with Social Security. If you're not claiming Social Security, you get this tax deduction. There you go. Well, it turns out that Social Security is really quite complicated, and they didn't give themselves much time. So they just said, I know, let's just $6,000.
Well, it doesn't have anything to do with what you're collecting on social security.
That's correct. It's based on your birthday. If
It's
you
called enhanced senior deduction. What's the AKA?
also known as,
Huh?
also known
Well,
as,
it's up.
just okay. Yeah. Yeah. But the way it was portrayed on the campaign trail was, we're not going to have any tax on Social Security. This is how it got into the tax law. So I mentioned if you're married filing separately, you don't get this deduction. And it phases out if your adjusted gross income is 75,000 or more, 150 for couples filing jointly.
And you don't get the deduction if it's more than 75.
It starts to phase out. I forget the maximum you earn before you get no additional tax deduction, but you get into the kind of income levels where you're probably going to have other things going on that you'd be using to reduce your tax liability. But yeah, if your adjusted income is 75,000 and it's or more, then it will start to be reduced. There's a formula. It's something like 0.6% per $1,000 or something like that. I could look it up, but I don't have it off the top of my head.
Bill, we get a
Yes.
question from the group here. Would
Yes.
you repeat it because the home people are not hearing the question?
Oh, okay. Yes. Yes. Okay. Okay. So then moving on, the last thing that we're going to talk about is the so-called Trump accounts. I actually heard that they were going to be running an ad in the Super Bowl for these, but I didn't see it myself yesterday. So I thought, if it's going to be on the Super Bowl, I'd better be prepared. So this is what we came up with. It's a pilot program, and it's going to be putting money into a retirement account for babies, basically. And it's going to be started with seed money from the Treasury. So the US government is going to fund these accounts, $1,000 per child. Right now, it's for children that are born 2025 through 2028. And the IRS is going to issue a form that will allow you to claim these, where you have to give the information on the child, the birthday, social security number, excuse me, and also how you want the money to be put aside, which financial institution, and some information on how to direct the investments. There is a website, it's called trumpaccounts.gov, and it can give you some more detail on this. The only thing I've really got to add about the investment directions is it's not going to be as flexible as a grown person's retirement account. The investments are going to be pretty much US based, and they're going to be low cost index funds where you can invest in something like the S&P 500. You can't go picking and choosing individual stocks and play in the market like that. It's going to be pretty much a set it and forget it kind of investment based on that $1,000 that the child gets in its name.
What? You get that every year?
No, okay. The question was, do you get the $1,000 once or every year? It's one time only, and it's just seed money to start the account in the child's name. Okay. But there's more. So it's it's actually a pretty good idea to have some money accumulating over time and being invested in a child's name, because compound interest really can add up over time. If you start when the child is born, by the time they're 18, they're probably looking at real change. And so 18 is when the child becomes adult legally, and then the Trump account starts to follow things that are more like the traditional IRA rules. So the once you come to age 18, you can take distributions from it. But during the run up to age 18, you can also be adding 5,000 a year into the account. And that can be from an employer, a parent, grandparents, money from mowing the grass. But there's a maximum that can be contributed to the account each year. And that is after tax $5,000. So unlike a traditional IRA, there's no tax deduction for contributing to it. But this goes to the basis in the account. And so once it's been taxed, it won't be taxed again when you withdraw it. Yes. Somewhat, yes. It does grow tax deferred. So all of those investment gains, they'll go onto the principal, and they're only taxed when you bring them out, when you take the withdrawal out of the account, which is just like a traditional IRA or a 401k. And then because that $1,000 seed money was a gimme from the government, then when you take that out, it's taxable. So that's life with the IRS. So that's what I've got for the 2025 tax law changes. So do you have any questions about any of that?
Are the Trump accounts paid in crypto?
Okay. The question was, are the Trump accounts paid in crypto? And I don't believe so. I think they're good old-fashioned US dollars. But remember what I said about tax laws being permanent? Until they change the law, that's the way it will be. Yes, ma'am.
The Social Security Fairness Act, you said teachers and firefighters. Are there anybody else included in that? That's the only two groups.
The question was on the Social Security Fairness Act, the kind of employees that are going to be eligible. Is it only firefighters and teachers? The answer is no. There are more than that, but those are just two of the best examples.
So did those two groups contribute to Social Security and just can't draw it because of their pensions?
They couldn't previously, but can now. Yes.
And my mother put into Social Security, but she's on my father's pension with the railroad, and she's not allowed to draw her Social Security out.
Railroad is different again. Yes. Yes, we have a couple of railroad retirement accounts every year, and they are similar in a way to Social Security. I don't know how this would apply to them. Honestly, haven't thought about that aspect of it. But if it's railroad, that is equivalent to Social Security in some ways. I would think that this would not apply, but I would certainly want to check. Okay. Anybody else? Anything that's not clear, needs further clarification? Really? If I explained it that well, I'd probably get kicked out of the tax team.
Just got a text from somebody that said, excellent presentation.
Oh, well, thank you, whoever that was.
How much can be deducted for donations to charities? If doing the short form.
Okay, the question was how much can be deducted for charities using the short form?
Charity.
Mhm. Yes.
Got that on a short form.
Yes, sir.
How much?
Okay, this comes back to the point about the standard deductions. Charitable contributions are they used to be more effective as an itemized deduction. Because of the 2017 tax law changes, there's a much higher standard deduction now. So for your federal income tax, you would have to have more than the standard deduction to make it worthwhile. So technically, yes, it is deductible. Don't believe it matters which form you're using. But you would need more than the standard deduction. That said, that's for federal income tax. State of Kentucky also allows you to deduct charitable contributions in addition to what's on the federal returns. So if you've got some substantial charitable contributions, then you should certainly enter them onto the federal return, but also make sure they're entered into your Kentucky state return, because the states and the federal governments handle them a little bit differently. On that point, there are three things that Kentucky allows for that. So there's the charitable contributions, there's mortgage interest, and there's also gambling losses. So if you've won some money at Keeneland and you've also lost some money at Keeneland, keep tabs on that, because those losses can offset the fun money that you won when you were betting on the horses. So mortgage, charity, and gambling are three things that are helpful on your Kentucky state return, even though they don't affect your tax liability on the federal return.
I've got a question, Phil.
Okay, I'm sorry. You've got one from Mike. Yeah.
This is different question. For 65-year-olds or older, the deduction would be 17,500 plus 6,000.
There's actually more to it. Okay, let me repeat the question. The question was, if you're 65 years old, then or older, and you're single, you have a $17,000 standard deduction plus the 6,000 for the enhanced senior deduction. There's actually more to it than that, because there is yet another deduction I didn't talk about because it's been in the law for quite a few years. There's an additional couple of thousand per person if you're over 65 already. It's 2,000 if you're single, 3,600 for a married filing joint couple. So you would have the 17,000 plus 2,000 plus 6,000. That would be the standard deduction at that age level, 65 or over. Okay, and I'm sorry, there was a question from the group. Someone had a question.
Yes, Phil. Phil, I had a question. Wasn't there a provision in the changes about charitable contributions that don't take effect until 2026, which would essentially be when we file our taxes next year? You can take, in addition to the standard deduction, you can take some charitable contributions. Are you familiar with that?
Yes, that is quite correct. I didn't mention it because it doesn't pertain to the 2025 tax returns. The question was, isn't there another tax deduction coming for 2026 regarding charitable contributions? And the answer is yes. There's two aspects to it. There's more organizations are being given charitable status, more, and they are generally veterans groups. So some of those, when you contribute to them, they'll be acceptable as qualified charitable deductions. And in 2026, there is, I believe, another $1,000 will be allowed as a below the line deduction if you make that level of contribution, and it's to a maximum of $1,000. That's my understanding of it right now, but it as you pointed out, it doesn't begin until 2026, which we're in now. So any charitable contributions made this year, there's another $1,000 being allowed as a below the line deduction when you come to file your 2026 taxes, which will be this time next year. Okay, I'm sorry, I can hear somebody speaking, but I can't make out what you're saying.
It's covered by Medicare and most private insurance. I can continue to do other things that I enjoy doing. I feel better about myself because I know I got the proper care. Our FDA approved treatment has no downtime or recovery period.
Okay, is there another question? Or just someone having a conversation?
6 months and feel better. There's a breeze in and out, and it's painless. Arthritis knee pain gets in the way of everyday life, but you don't have to live with knee pain. Call Arthritis knee pain. It's going to be a no charge, long knee pain screen. It started on your journey to a better everyday.
Yeah, I'm sorry, we can't make out what you're saying. Is there a question?
I don't think so.
Yeah, if there is a question, can you type it into the chat box, please, so we can figure out what how to answer?
Okay, we'll monitor it.
Okay.
Okay, you got a question?
Yeah, one more question. Yes.
This from my husband before I came here. RMDs, the required minimum distribution from IRAs. He's going to have to take his first one this year. He turned 73. He had been told by somebody or read it that he could delay it until next year, but then he'd have 2 years worth to pay taxes on. Is that true, or should he go ahead and, I mean, can he delay it?
The question is about required minimum distributions from retirement accounts, and it's when the first time you have to take the distribution, do you have to pay it immediately or can you delay it? And I believe that you can delay it a part of a year, but you're also correct in saying that if you do delay it, you're not avoiding taxes, you're only delaying them. So you have to pay up sooner or later.
So
And it turns out
next year instead of just one.
instead of 1 year and then 1 year. Yeah. You only bump 1 year out. You don't bump all of them out by a year. I'm afraid not. I believe that question's come up before.
So at somebody at half, you can begin taking from your IRA, regular IRA, and giving it to charity.
Yes.
Yes.
And, but you don't get a deduction.
Yes.
You
Yep, you do.
You do get a
Yes.
deduction.
Yes, but I believe the one you're talking about is if you have the IRA, the company that holds your money, they send it directly to the charity. It doesn't go through your pockets. They send it directly. That's a qualified charitable deduction, and that can be used to offset the required minimum distributions. Yes.
Anything you give to a charity, you don't have to pay taxes on.
Well,
And
I
that
do
deduction.
that, but I don't think that's right. You can give it and not pay taxes on it. I understand that.
Mhm.
But you don't get a deduction from your taxes.
But if you have the IRA company send it directly to the beneficiary. then that becomes a below the line distribution. It's in addition to the standard deduction. So you get that tax deduction either way. If you are taking a standard deduction, it doesn't matter whether you've made any charitable deductions or not.
It's like
So-
you never collected that money to add to your income, so it does,
Mm.
yeah.
Yes.
I understand that part of it, but,
Okay.
I'm confused. Well, say you give $10,000, not from your IRA, but from a stock portfolio. So,
Mhm.
then you can, you itemize that can be a charitable deduction.
Yes.
But from an IRA, you don't get the credit for it. Anyway, I have to research.
Well, no, what you're trying to say,
further.
so simply, if, say, you're taking a distribution of $50,000, but you tell your institution, send 20,000 to American Heart Association. So they send you and they only give you 30,000,
Yeah,
so that 30,000 is taxed.
yeah.
Yes.
You don't pay any tax on that 20,000.
Also, you can't claim it as a charitable deduction
Correct.
from your return.
Yes.
It's on your return, but it's in a different place than the regular charitable deductions. The regular charitable deductions, you have to be saying, well, okay, is it better to take the itemized deductions or is it the standard? If you have your financial institution send it direct to the charity, you get that deduction whether you take standard or itemized. In addition, like the examples we had for the tips and the overtime, they were in addition to what is being claimed as either standard or itemized. So in addition to, and those will also count against your qualified required minimum distributions. Okay.
The language is really unclear. And the IRS. Yeah,
Yes,
supposed to be very unclear.
okay. Anything else, Mike? Okay, so that sounds like that's it. So last chance, any questions? Going once? Going twice? Okay, thanks everybody. Appreciate the attention. If you got any questions, then you can call us at the office.